Good morning, everyone. We do have a ton of people getting on this call, so I'll give another minute or two. Thank you for those who are on time. It does mean a lot. I appreciate it all. Looking forward to having some fun here, okay? Give another minute or two and we'll go ahead and get started here, okay? Denny, glad you're on the call, Denny. Give you a little shout out. Hello to you too. Brian Hanley, how you doing, buddy? Glad you got on the call. Looking forward to spitting some knowledge here. All right. Good morning, good afternoon, depending on where you're in the country. My name is Josh Elohim. I'll be your speaker for today. Regarding tax-deferred growth, tax-free distributions, and tax-free death benefit. What else do we have to say? Should I just end the webinar there? I'm just joking. Glad to have you all on the call. Just some quick housekeeping to keep this thing rolling. Everyone's going to be muted for the purposes of the call so we can get through this thing smoothly. Do me a favor, please put all your questions in the chat box or in the question box there. We'll go ahead and get all those answered, hopefully as many as we can. If we don't get those answered, you can reach out to your marketing manager and they can answer those questions as well. If for some reason you do not have a marketing manager and you're on this call, you can go into the chat box where there's a link in there. You click on the link, you can go ahead and set up your account and you'll be rocking and rolling there. So again, if you don't have a marketing manager, you're new to Quote and Apply, go ahead and go into the link and there's a place in the chat box to click on the link. People are just jumping on. I feel bad for getting started here, but I want to reward the people who are on time. So again, thank you all. Really appreciate the opportunity. So I try to make this the header of this webinar all about taxes, right? Because as a country, it's been really challenging, right? And we know kind of where we're heading right now. So people always say, like, are taxes going down or taxes going up? And I think most of us know the answer to that question, but I give 3 reasons why. And this is not me, this is from a book, Patrick Kelly, Tax Deferred Growth. He talks about 3 reasons why our taxes going up. So the first thing is that our deficit, what are we at, like $35 trillion right now? And we're just giving money away like it's no one's business. So that's the first reason. Second reason is Social Security. Is that going to potentially be there when you and I need that? The third reason is our healthcare system. So that's 3 reasons. If anyone is questioning if taxes are going to be going up, that's 3 reasons to give your clients to say, hey, this is why we feel like taxes are going to be going up. The questions are already coming in. I love it. So hopefully you're all familiar with our technology. We have Quote and Apply. I'm not going to spend a lot of time on this, but if you have not, Quote and Apply is the first ever multi-carrier, agent and or consumer facing, and it's an e-application for life insurance. So to keep it simple, that's what this software does. We give you, the agent, a link, a landing page, a website. It allows you or your client the ability to run life insurance quotes in seconds and apply in minutes. Again, I'm not going to spend a lot of time on this. Let's go pretty quickly here. So you or your client puts in their first last name. They put in male, female, health status, drop that in, smoking status, Height, weight, you can skip it. It's a personal question. You put your client's date of birth in, and minus us talking, we get rates, right? There you go. Today, I want to really focus on cash value, permanent IUL insurance, okay? So let's just go to lifetime coverage here. Part of the game changer here is that this stuff used to take 5 or 6 meetings to close in the past, right? And a lot of time you lose your client because it's taking too long. With this software, we're seeing stuff happen in 1 or 2 meetings now. So look, if I want to talk about, if I want to get into before I dive into the IUL and dive into illustrations, what I want to do is give people visuals. And I think you maybe have all seen this before, but I'm going to go to accumulation IUL here. So when I click on this, it's going to pull up an illustration for me here, right? And I'm going to pause right there for a quick second. What is IUL? It stands for Index Universal Life. See, in the past, all we had was variable life insurance. Variable life insurance was great. The market did 20%, right? You get 20% credit to your account. You're super happy. Everyone's happy. Next year, the market does minus 20%. Now, the challenge is you were getting a negative loss there. And these policies, when they go negative, it's very hard to recover and get back to positives. So the life insurance carriers finally got smart and they created something called IUL. So now if I use the same exact situation, let's say the market does 20% with an IUL, you have a cap of anywhere from, call it 8 to 12, depending on the carrier. So you're not getting that 20, you're getting that cap of 8 to 12. But next year, when the market does minus 20%, now you have that zero floor. So the reason why this is genius is because you're going to participate in the upside of the equation, but not the downside. Does that make sense, Andreas? How's it going? So again, your client's going to participate in the upside of the equation, but not the downside. So you have that zero floor, which is really your protection, right? So what I want to do now is if you run any permanent illustration and you hit show details, does everyone see this tax-free click here button? Now this is called the bucket sheet, because we know that everyone hates life insurance, including myself here. But what do I hate more than life insurance? Anybody? Anybody? Paying taxes, right? There you go. So I always like to get people's blood boiling right away when I talk to them, because then I get their attention. So what this piece shows me is my top income earners for my top tax rates. And when you add this up in California, add this all up, we're close to 50% here. Now I call this the bucket sheet because if you look, this is where your client's money is. A lot of agents just go right into selling and they don't take the time to explain to their clients, why are we doing this? We're not just doing this to make money. No, that's not the case at all, actually. So take a look here. People put money in these 3 buckets here. The first, you have your tax deferred bucket, your 401k. To me, that's a great bucket. If someone's willing to match you on the percentage in that bucket, I would put that percentage of the money. So if someone said, hey, we're going to give you 7%, I would put 7% of my money in there. We have a lot of people, and you can ask your client this, a lot of people max out their 401k. If that's what they want to do, it's fine. What's the challenge here is they don't realize that when they pull that money out, how are they going to be taxed? So we'll go through these 3 buckets. So again, this is a great vehicle. Then you have your taxable bucket, your stocks, your bonds, your mutual funds. Where else can you put in $100,000 and earn $1 million? Really nowhere. It's a great vehicle. I personally work with a lot of financial planners, and I'm like, life insurance is not designed to beat what you're doing. What it actually does is protect what you're doing. We'll get to that in a second. So you have your taxable bucket. Again, another great vehicle. Then you have your tax advantage bucket, your Roth IRAs. Now, what's the problem with that bucket is people who make too much money, they don't qualify for that. So I'm a big component of it. So again, these are 3 great vehicles. I'm a big fan of these. I would never say to put all your money into life insurance. To me, that'd be foolish, because there's other great vehicles. Now, what's the challenge with these great vehicles? Well, if you see these little spigots right here, does everyone see that? The challenge is, how am I being taxed in these 3 great buckets, pre-59.5 up to 70.5? It's not how much money you make, it's how much you get to keep, correct? So if I didn't have your attention before, I have it now, because we're talking about your money. So when you go into these conversations, it's really important to talk about where your clients are spending where they're putting their money right now. And again, I don't ever look bad on anything here. These are great vehicles until I want to pull that money out. That's where it becomes a challenge. In that book, Patrick Kelly, Tax Deferred, Tax-Free Income, he talks about he knew a client that put all their money into the 401k. They had $3 million in the 401k. So he had 3 kids. So his goal at retirement was he wanted to give $3 million to his kids. Well, what do you think happened when he went ahead and tried to take that money out? He ended up getting about $1.4 million after taxes crushed him. So this is really important to understand how these vehicles work and to diversify. So there you go. So that's how I'm being taxed in those 3 buckets there. Now here's your sale. What if there's a way if I could show you how to create non-reportable tax-free income? Something you'd be interested in? No one said no to that in 11 years. So there's one more bucket you may not be familiar with, and that bucket's called life insurance. And a lot of people say, I thought life insurance was for a death benefit. No, that's called term insurance. So how does this bucket work? Well, pre-59.5 up to 70.5. And as you already may or may not know, the beauty of cash value life insurance is that the money grows tax deferred and you can take the money out tax free. So there you go. Just so you know, I've been doing this for a long time now, and what I've started doing was helping agents to get on the phone with their client. Now, your marketing manager can also do this as well. So whoever that person is, let us help you. We're here to help for at least the first couple cases, right? Let us help you to set up your meeting with your top 5 clients. We can have this conversation. I don't change really anything at all. I talk to you all like I'm talking to a client, because I just want to educate people and really spread the good news here. We don't sell anything here. So there you go. That's a good visual. When people see this visual, they start thinking about their buckets, right? So how much money are you putting in your 401k? Well, I'm maxing it out right now. Well, that's, obviously I'm not a firm believer in maxing it out. I like matching whatever that percentage is. So you might want to consider reallocating a piece of the money you're putting in here to put it into life insurance. Why? Well, because if you want to pull from these buckets at all before 59.5, we're going to get a hit with an ordinary income tax plus 10% penalty. Did you know about that? I had no clue. Because a lot of people, again, are stuck in the growth phase. They forget about the distribution phase. So again, great vehicles here. So you're telling me that if I if I get my client to get an IUL policy and I have assets under management, this is going to protect my money under management? Well, let me ask you a question. If you want to pull money out of one of these buckets here, which one do you want to pull from? I'll wait. The answer is you don't want to pull from any of these buckets because you're going to be taxed on those buckets. You want to pull from this one right here. So what are we really doing for you, Mr. and Mrs. Client? We're creating a 4th bucket that you do not have access to. And what is that bucket? That bucket is non-reportable and tax-free. And I'll explain that when we get into the visuals here. This is called the bucket sheet, you guys. Again, it's right here when you run your quote. How do I get there? I just hit show policy details. Does everyone see it right there? If you need, reach out to your marketing manager. We can email this to you, but it is right there at your fingertips right there. Perfect. So when I ran this illustration, let me close this up here. If your client needs a certain death benefit, right, there's a few ways you can do this. But let's just say they're adamant about having $1 million. Well, this, when we first ran here, is called what we call a max non-MEC, meaning the most money I can put in based on $1 million. This is a good way to run this. So you can do, I need $1 million death benefit. I want to make sure it's permanent insurance. I put that $1 million in. We have a max non-MEC. In other words, this is the most money I can put in without MECing the policy. Is everyone with me? Just to recap, what does a MEC mean? Modified endowment contract. In the past, life insurance was so good, you could literally put in $1 million and take it out right away. And then the government said, whoa, 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 slow down here. We're not getting our piece of the pie. So they created what's called a MEC, modified endowment contract. So now if you put too much money into a policy too soon, then what's going to happen is that you're going to have to pay taxes on the first dollar that comes out. Does that make sense, everybody? So if your purpose is using this for retirement income, you do not want to MEC a policy. There are situations where you can MEC it if you're not going to touch it at all, then it doesn't really affect you as much. But most of the time, people want to have flexibility and access to their money. Another way you could do this is that you could separate these sales, and if someone wants $1 million death benefit, you could do $1 million in term insurance. That's what it's for. Highest death benefit, lowest cost. And then I can look into doing, and if I wanted to do that, what I would do is change this from max non-MEC over to a minimum non-MEC. All right, so what just happened here? Well, the first thing you visually see is that now I can actually plug in a dollar amount. What does the minimum non-MEC mean? Well, it's the same thing as the max, but now we're going to do the lowest death benefit possible. Well, I need $1 million. Well, guess what? We can get $1 million in term insurance if you'd like, right? So again, when I do a minimum non-MEC, there's two very important things that happen for your client that they care about. The first thing is that when I lower my death benefit, I lower my cost of insurance charges. So I'm going to have the lowest cost of insurance charges possible. Does everyone understand cost of insurance charges, why those are there? Well, guess what? If you bought a policy today, correct, and you're not here tomorrow, the carrier's on the hook to pay that claim. Is that correct, everybody? So that's why they have cost of insurance charges. They have to cover that risk right there. But again, by doing the minimum non-MEC, we're doing the lowest death benefit possible. It also lowers your agent's commission. Sorry about that, Brian. So I joke around with the client. I say, well, if the money's not going to the carrier necessarily, it's not going to the agent. Where is it going to? Into your policies so we can grow faster. Does that make sense, everybody? So again, when I do that minimum non-MEC, now it frees me up to ask the client, now that we've gone over your finances and what where your money is, how much money are you comfortable putting in this policy on an annual or monthly basis? Let's just say we were doing this monthly. Okay, great. So we're going to do $1,000 a month. Now, again, I don't want to pay premiums when you're 50, 60, 70, 80 years old. Is there any other options? I'm glad you asked that question. I can pay to age 65, but my favorite is a 10 pay because people can see 10 years down the road. Would you all agree? So have a look here. I'm going to show max distributions from age 66 to 90. Now we can change this. I'm just starting here, okay? So when I hit the rerun button, again, we've never been able to pivot and change things so quickly. Did everyone see how fast I just did that? No one wants to wait anymore. Nobody has patience for anything anymore. Add a pandemic to that, and it just inflares this no patience thing, okay? So if everyone's looking, there's my illustration. Look how simple that was. So I can sit there and I can click on my PDF here, and I can actually pull this up and dance on the spot here. I can go down here and make some changes, but people are visual. 90% of people learn visually. We make mistakes as agents by doing what? By talking people to death and not giving them any visuals. I have a 90% close ratio when I talk about this stuff, and it's not because I'm doing anything special. It's just because I can physically show them everything I'm talking about, which I'm going to do for you as well. My tab button's acting up here. Let's just do this thing, Matt. So here we go. So on the spot here, did everyone see what I just did? I can dive right into this, and look at, I can zoom right in. How cool is that? We're in the illustration on the spot right now. Has anyone left their chair? I know I haven't. I'm still in the same place. So we got a male here, 44, preferred non-tobacco, right? Again, this is our minimum death benefit, the lowest possible, that $198. We're putting in $1,000 a month, or we're doing $12,000 a year. Is everyone with me? And we're doing that for how long? We're not saying to pay forever. Pay for 10 years during your income earning years, or I can physically see this. Just some basics that a lot of the clients want to know, and you can answer their questions before they even ask. So what are the costs of this? Cost of insurance, right? A very simple way. I take my $12,000, I subtract it from my accumulation value. That's what's currently growing in the policy. So look at that. Year one, there are my fees. Okay, why are there fees? Because if you're not here tomorrow, guess what? Carrier has to pay this amount out right away. That makes sense to me. All right, there's the risk they take. Now, I also have my surrender value. So what does that mean? If I want to pull every dollar out of this policy and walk away, that's what you'll get right here. So if you're thinking you're going to put this money in year one, take it out year two, this is not the best vehicle for that, right? Perfect. All right. So how is this calculating here? So look, if you look, I'm running this at a 5.74% interest rate. To keep this very simple, I'm a simple person. How does this work? This is based on the S&P 500. Whatever the S&P 500 does for that year, that's what you get credited to your account. Very straightforward. Again, you have your cap, and then you have your floor. Caps can be anywhere from 8 to 12%, and a zero floor. We're running this at 5.74. So take a look here. I put in my 120 grand, right? Now, this is not a secret. This is just compounding interest, right? So I let this grow, and let's look at my retirement age here, right? So I have, at 66 here for my retirement, I have a few options. I have access to about 235,000 of tax-free money. You're going to keep hearing me say that, right? Of tax-free money. How much do you have to earn to get to make 235,000 of tax-free money? There you go. Or the smartest way to do this is to use this to supplement my retirement, because I have other buckets, right? So I'm going to pull out, call it about 18 grand from 66 all the way to my age 90. At that point, I pulled out 328,000 of tax-free income. Oh, and by the way, at 90, I still have, look at about a $30,000 death benefit. Does everyone see that there? Not a bad little burial policy, right? So I took out all this money, and I still have my death benefit intact here. We are showing, that's how this works here. It's very simple, very straightforward. We are showing, again, a 5.74% interest rate. The S&P over the last 30 years has averaged around 10%. Now, when you have to factor in that cap and that floor, right? So we're probably looking at getting more like 6, 7, or 8%. But this is the definition of under-promising and over-delivering. Would you all agree? So I sleep very well at night because I know, as everyone knows, if you get a 6%, a 7% on average, this is going to look much better. Would you all agree? Again, under-promise, over-deliver. Here's what we're doing here. That's how simple it is. Let's go back up a few more points that your clients want to know about. And why not just tell them up front so they don't have to even ask the question, right? So this is what we call a flexible premium contract. What does that mean? Well, we're showing a 10-pay here, right, everybody? So I'm paying for 10 years. Let's just say business is going really well. If I want, I could just pay year 11 if I wanted to. Vice versa, let's say we had a really tough year in year 7. Because you have cash in the policy, you can borrow from this policy and use it to pay the cash. You can use the cash value so you can skip a payment if you need to. Again, I love that flexibility. Your client needs to understand. They don't obviously want to skip it, but if something happens, things happen. There you go. So you have that flexibility. Now, another thing that comes up is that you or your clients have access to this money after the first year, if and whenever you want, for whatever reason you want. So the question is, let's go back and forth now. Again, we're visual learners. So look, if you need to borrow 20 grand, Mr. Client, which bucket do you want to pull from? You see, I always go back and forth because that's how visually we are. I don't want to pull from any of these buckets. Now I see how I'm going to be taxing them. Bingo, there we go. So what are we doing? We're creating that fourth bucket. That's non-reportable and that's tax-free. And we're going to explain that tax-free part right now. So here we go. So I can have access to this money. I always encourage people, whatever your time frame you pick. So in this situation, we picked a 10-pay. I would encourage them not to try not to touch the money during that funding period. Okay, so this whole tax-free is kind of a gray area. Like, is it really tax-free? Again, I'm a simple person. Here's how I explain it. Life insurance is paid for with after-tax dollars, which gives me the ability to take the money out tax-free. A very simple visual you can give to people is that, let's say you're a farmer, right? Would you rather pay taxes on the seeds that you're buying, or would you rather pay taxes on the harvest? That's all we're doing here is we want to pay taxes on the seed, obviously, so that way when the harvest comes, we don't have to pay taxes on that. Are taxes going down or taxes going up? How many of you have heard clients say, hey, I'm just going to defer. And when I retire, I'll be in a lower tax bracket, right? We know that's probably not going to be true, correct? So what are we doing here? We're trying to create that vehicle. Is this bucket designed to make more money than this taxable bucket? Absolutely not. No, that's not what it's for. It's actually designed to protect this bucket right here. Does that make sense, everybody? It's designed to protect this bucket because the longer you wait to pull out taxes to pull out money from these buckets, the more money you get back that you're not going to give up. That's a really important to understand. Now let's go over tax-free here. Sorry, I'm jumping around a little bit. So again, life insurance is paid for with after-tax dollars, which gives me the ability to take the money out tax-free. So have a look here. Here's how you'd physically do this. So up to what you put in this contract is called my basis. So in this situation, I put in 120, right? So what I'm going to do is when I want to take this money out, I've already paid taxes on my basis. So I'm going to call and take that money out via a withdrawal. It's just like calling your bank and saying, hey, I want to take money out. They don't ask any questions, right? So up to my basis, withdrawal. The next dollar that comes out, you might have heard this terminology, become your own bank or bank on yourself, because now I'm going to switch over to a loan. And that carrier might charge you 1 or 2 or 3% to borrow the money. But what they do is they credit me back that same 1 or 2 or 3%. So it's what we call a wash loan. Now, here's the key factor. As long as you never surrender this policy, you die with it. What is the death benefit to the beneficiaries? Anybody? Anybody? Tax-free is the answer I'm looking for. So let me repeat that one more time. As long as you never surrender this policy, you never get rid of it. In this situation, let's have a look here. In this hypothetical, we've pulled out 328,000, right? My policy is still intact at 90. Do you all see that? So I never surrendered this policy. I pulled all that money out. As long as I never surrender it, you're never going to have to pay taxes on the gains in the contract. Does everyone understand that? Really important to understand. This is not a new thing here, you guys and gals. You remember that you learned this is just compounding interest. You probably remember that in your accounting class in college, right? The professor said if you put away $1 a day from age 18 to 65 every day, you'll be a millionaire. I don't know about y'all, but I didn't listen though. So, but that's really what it is. It's just compounding interest. Very simple. And with the IUL now we have the flexibility to have that protection with the cap and the floor. Does that make sense, everybody? This is great, Josh. You went to your client. This is great. $1,000 a little too rich for my blood. What about $750? Well, in the past, you have to wait a week to go back to your wholesaler, right? Well, now look at this. $750. Just put your $750 in, go to the bottom, and hit change. So when they ask questions, you're able to pivot very, very quickly. Okay, so thank you for showing me $750. Well, let's do this for 15 years instead of 10. I'm telling you all, this is a game changer to be able to pivot. It's like millennials don't appreciate how fast this is. They say, this is the way it's always been. My favorite agents, the one who've been doing it for 30, 40 years, and they're like, I mean, they're just blown away. Like, I can't believe that I have the flexibility to be able to maneuver right in front of the client. We have agents I know some agents used to do their illustrations with rock and a chisel, right? So it's like, you really have to appreciate what you're seeing here. And this is why we don't have 20 carriers on here, right? Obviously, we don't, with IUL, there's a lot of moving parts. Does everyone see how fast this is working here in the background? Most of the companies are not hip when it comes to technology to be able to even do this. So I can make a ton of changes here. If I don't want to show no distributions, I don't have to show any. So most of the time when you answer all your clients' questions, the next thing you hear is, what's next? Now, we all know what to do at that point, right? Everyone's trained there. Well, in the past, you pull out a 60, 70-page paper application. Your client has a heart attack, dies on the spot, there goes your case, right? Well, now, does everyone see this continue button right here? Boom. I just went right into the application. No more paper. A joke I always make with the client, I say, whoa, slow down there. I'm glad you like Nationwide, but they want to date you as well. What do you mean? Well, all you're saying yes to is an application and an exam. That's really all you're saying yes to. And the biggest hang up that I've seen with people is that they don't know how much they want to put in. So here's a very simple way to get them to move, because again, we don't know if Nationwide is going to like them or John Hancock's going to like them, right? So apply for the most you might want. What do you mean, Josh? Okay, let's go back here. The most I might want is $1,000. That's the most I could put in. All right, are you sure? Okay, just want to make sure. We still have to go through the underwriting process. So what I'll do is I'll change this to 1,000. That's the most I might want. I hit the rerun button, right? Once we get the offer, then we'll know what we're really at here, because we could apply it preferred and we get a standard. We could apply it preferred and get a preferred best. The numbers are probably going to change either way. So let's not spend 4 or 5 weeks thinking about how much I want to put in here. Just apply for the most. And that normally makes sense to them. And they say, okay, let's do this. So perfect. I hit the continue. Now here's the application. I put my email and my phone number. 2 very important things are going to happen when I hit this next button. The first thing is whatever email you put in, that client's going to receive an email. So technically, you could walk away and let them finish the app themselves if you wanted to. Now, if you're using Zoom, why not just keep going, right? Okay, so we just did that. That just happened right now. Let's say I put my information, just 310. Does everyone see all the information is auto-populated? We pull from the computer's IP address, which is scary and cool at the same time. Is this person employed? Let's just say yes. We'll do back 9. We'll say sales. How long? I put my company address in there. Auto-populates. Beautiful. Will this person own the policy? We do a ton of key man and buy sell here for business owners. And people think it's like this sophisticated sale, but the only difference is the ownership. That's really it. So if the answer is no, look at it. If it's business owned, there you go. It could be owned by a trust or an individual. Just to make it easy, I'll say yes. And we'll just make, again, trust, business, individual. I'll just say back 9. We'll do sales. We'll say this is the wife. Next. I can add a contingent beneficiary to back up the primary here. So it's really simple. I could skip that. Income, assets, liabilities. We do have several integrations. So if we're integrations like Redtail, if you use Redtail, this is integrated already into Redtail. We have several others that you can now search. We have several different companies that can do integrations to auto-populate this agreement to make it easy. Does this person have an existing life insurance? If yes, I plug it in here. As you see, we are set up for 1035s here if we wanted to. Let's just say no to keep moving forward here. How many of y'all have seen, by a raise of hands, which I can't see, being able to pull these medical records? Have you all had nightmares with medical records? I know I have. Well, on the spot here, I can pick my facility. If it's not here, I type it in up here. So let's just go with Kaiser. I call it the kiss of death here in California, right? I ask the client, username, password. If they're not comfortable, I can actually pass the screen, let them do it themselves. When I hit that connect button, we're able to pull those medical records instantaneously right on the spot. That is an absolute game changer for our business. Josh, I forgot my username and password. You can reset it right here. I don't have an account. You can create one, or just say no and skip right by this. You can send a text message or an email. That'll go right to you as soon as let your client finish it on their own free time. Or just say no, skip right by it. If I didn't put that height weight in the beginning, I have to put it in now. Preemption does just have a few questions. I'm not going to beat around the bush. That's why I picked them. We can actually potentially bind coverage, or at least collect the routing number and account number, so we don't have to ask for it again, or just say no. But last raise of hands. How many people have had issues with exams? What a nightmare, from the examiner to the agent to the client to the GA. That's 4 ways things can go wrong. So if you look here, how about a built-in calendar from exam 1 based on whatever zip code you put in across the country? This is available in all 50 states. So what day works best for you, Mr. and Mrs. Client? Okay, let's do this Saturday at 8:30. I confirm this is the address you want. Okay, perfect. We just booked the exam, everybody. It was that simple. I don't know if we can make it any easier than that. So the client gets a calendar invite right to their calendar, so don't forget about it, as well as the examiner calls the client the day before. Ever since we've implemented this new system, our exam completion ratio has gone through the roof, and you can probably see why, right? Perfect. Last step here. I'm not using Zoom, or I'm not using a software, or Teams or something like that. You can hit sign via email. Let's say you are using Zoom, I would hit sign now. Or your client's doing this 100% by themselves, which I've also seen, believe it or not, IUL without talking to a client. Or we get past this pandemic, you can meet your clients face to face again, which I know we're getting there. You can do it all right here. So just like that, all the information auto-populates the DocuSign, a fully completed 60, 70-page paper application. Don't take my word for it. Here it is. My finger's getting tired here. You all know how DocuSign works. I usually pass the screen, by the way, at this point to the client or the agent, let them do it themselves. I'd pass it right here, by the way. So they hit adopt and sign, and then we're off to the races. Point and click. Welcome to the future of where life insurance is heading. I normally do a mic drop and just leave right now, but no, we still got to do a Q&A session. So listen, I mean, this is a game changer for us. We absolutely love the software. It's been great. We're not geniuses. We got here because we've actually listened to the cries of the people. And what I mean by that is you, the agents. What do you like? What do you don't? What do you not like? And then from there, what we've done is we've done this crazy thing where we actually listened. I know it's crazy, but we actually listen to people. And that's how we're able to get here. So do me a favor. Keep giving feedback to your marketing manager. Hey, I like this. I don't like this. What do you think about adding this? Because I promise you, we will listen. Now, we have to make the change, so it's not always easy to make the change. But if it makes sense, we will add it to the system because we want it to be better for you. So we have some marketing tools. The questions are pouring in. I love it. I promise I'll get to those questions shortly here. We have some marketing tools. You can go to the boss and you can go to marketing. And we built these templates. Just so you know, the IUL template is get started on future retirement. This is where you get to go when you manage your money properly, right? So here you go. There's your campaign. It'll bring you, got the create tax-free retirement income. It'll go to your link, your picture, your contact information. You have two options. You can manually plug in up to 100 emails at a time right here, maybe copy and paste from somewhere, Outlook, hit the submit button. If you have your own email service, all you do is hit HTML, and now I just hit copy. I can drop this campaign directly into my email service. Does that make sense, everybody? So I have those few options right there to how to market this to my clients. We also have our email signature. So we have short videos that you can use to post right on social media. You can add that to your email signature. If I'm your marketing manager, go into any email I sent you, and there's a 451-second video on tax-free income. So people don't have patience, right? Where you can watch those videos and you can send them out to your clients and then attach your IUL link. That's how simple it is to market this thing. You can also put those links on social media as well. So there's several different ways. So we might have a record here for questions, by the way, you guys and gals. So what I wanted to keep this somewhat around 30 minutes. Again, the whole purpose here, I call this two things. I call it a forced savings account because unfortunately as Americans, a lot of us are guilty of this, but we're not saving money. So we're guilty. So what does that mean? It means it's going to be working the rest of our lives. Would you all agree? We got to give people something that they can start saving while they're somewhat young. This looks good because of time. Now, the second thing I call this is diversification. What do you mean? Well, a lot of people are not diversified in their portfolios. They don't have this fourth bucket to protect them. I don't like life insurance. Neither do I. I don't like term insurance. I like permanent insurance. Now, listen, term provides a need. I have just had my 5th child, so I have $4 million of term insurance. If I'm not here tomorrow, my family's protected. So it does provide a need. But guess what? I have less than a 2% chance of using that. I know the insurance carriers love that term insurance. It's great for them. So the goal is, how do I get to permanent insurance as fast as possible? And that's what we want to talk about, is getting a piece of your term insurance converted over to permanent. So perfect. We want to help people. They don't know about this. You have to educate them on why permanent insurance makes sense. And to me, explain this way, it makes a lot of sense. So again, I'll wrap this up here. I want to open up the questions here. If for some reason you're not signed up with Quote and Apply, go into the chat. There's a link there. If you are, reach out to your marketing managers and let's help you guys to close some deals here. We're here to help. Your job is not to sell anything. Your job is to educate people. And when you do that, they normally say, what's next? Perfect. Well, thank you again all for being on the call. I went over longer than I wanted to, but there's a bunch of questions in here. Go ahead and take your time. If you have more questions, put them in right now. I'll answer the best of the best I can. Let's see if we can start selling some IUL here for the month of April. Let's kick it off here, okay? Reach out to your marketing manager with questions. If I'm your marketing manager, let's set up a time with your clients. Handpick your top 5 clients. I'll get on the call with you / for you. You're all very smart. You hear my pitch 1 or 2 times, boom, you're hitting the ground running. I promise you I can help, especially with business owners as well. I can do a great job with business owners. Again, thank you all. Really appreciate it. You all enjoy and have a blessed day. We'll answer those questions in a second here. Okay, someone asked me about the book. It's called, Patrick Kelly is the author, and it's called Tax-Free Income. It's a picture of an ocean when you see it. So highly recommend. I'm not a huge reader. I read it an hour and a half at my kids' practice. That's how quick I got it done. So perfect. Let's see a few more questions here. So someone said, what about those people that aren't insurable? Well, that obviously you have to be insurable to get something. There are annuities you can put money into that will grow, so you don't have necessarily the underwriting part of the equation. So I would pivot to an annuity if that's the situation, if the person is uninsurable. But normally that means they're older potentially. So, but annuity is what I would pivot to. So someone asked, is this good for a child? Absolutely. Who is this the best for? Listen, I know about 529 plans. Those are great plans, right? They're great. They can grow. The challenge with the 529 plan is that the money has to be used for health or education, right? That's the biggest challenge to me. And then also, I know that it's not necessarily hidden when it comes to doing the applications. Where life insurance, let's say little Jimmy doesn't act right and he doesn't do what he's supposed to do when he turns 18. Guess what? The money is in a policy which is owned by the parents. It could be owned by a trust. So if you don't fulfill your obligation and he doesn't go to college, the money the parents can do whatever they want with the money. So that's a great question. Who is this the best for? A 1-year-old, because they just have time, right? That's really it. That's why it looks really good. So yes, Natalia, an IUL is a really good setup for a child. And I would do a minimum non-MEC. That's how I'd run it. Lowest death benefit possible. Doesn't benefit you as much, doesn't benefit the carrier, but benefits the agent. And you can do all that right on Quote and Apply. So someone said, once you put the policy through, are you contracted with that carrier? We have a very simple contracting process. You go into your BOSS system and you just do your contracting as soon as you get set up and you're done. You can write with any carrier we offer. Because of just-in-time contracting, they give you 14 days after the application comes in to get the code set up, making everyone's on this call's life very, very simple. So that's a great question there, Regina. So do we have access to non-exam IULs? When you run that quote, you'll see it'll say whether there's an exam. So the answer is yes. I believe John Hancock will go up to $3 million for no exam. I know all the companies have something now where it's typically $1 million or less with no exam, but it says it right on the category there when you're looking. So if you click on that more details, it'll give you the exam option, yes or no. It'll say it right there. But I know we do have that. Good question. Just a few more here, let everyone go. So someone asked if a one-pay lump sum is possible. Well, normally that's going to MEC the policy. We talked about that, right? We do not want to MEC the policy in this situation because now they're going to have to pay taxes on the first dollar that comes out. What several companies have now is called a PDA account or a premium deposit account. To keep it simple, let's say I had 100 grand. I can dump in that 100 grand one time. And where we see this the most is with grandparents, right? Because we know the parents don't always have chunky money. the grandparents do. They dump it in for little Jimmy, $100,000 right away. So that policy does not MEC, what they do is the carrier will pay you, they take the money at 100K one time, they'll pay you 1, 2, or 3% on the money, so you're getting something for it. They'll just put in that 10 grand every year for you for 10 years. That way the policy does not MEC. It's a win-win for everyone. Grandparents or parents get rid of the money right away, goes into the policy, you get paid something on it, and you get to pull the money out tax-free on the back end. So that's how I do it if you have a chunk, a lump sum to dump in one time. Almost 99% of the companies that we have offer dual contracting. Someone asked, do they offer dual contract? And the answer is yes. The list is much smaller who does not. So if you need that, you can reach out to your marketing manager and ask them who does not offer dual contracting, but most of them do, just a heads up, okay? I got my first Mazel Tov. Thank you, Natalia. Appreciate the love. So someone asked, where can we see living benefits with each carrier for IUL? So living benefits, I mean, no Prudential, most of them have the living benefits, so it's something you can add on. You can't necessarily add them on to this. What we focused on today was cash accumulation. I don't always recommend adding that to the accumulation. I like to have a separate bucket, and that would be like doing a long-term care rider. I'm a big fan of long-term care. For you all who've heard me speak about it, I'm very passionate about it. We have a tsunami coming that's going to hurt a lot of people here, and a lot of us are not planned for it. So I'm a big fan of doing a separate policy for the long-term care rider, because now you're back to a death benefit, and you can, whatever your death benefit is, it gives you that pool of money for long-term care. You cannot add the long-term care rider onto what I showed you here if you're doing the minimum non-MEC, because again, it's based on your death benefit. So you'd have to do a different policy there. So I think I kind of answered that. Is there children's? A lot of people ask about the kids. Again, a lot of parents want to take care of their kids first naturally. What I always say is take care of the parents first, and then you take care of the kids. By the way, if you want to get a kid life insurance, they're only going to give you half of what the parent has. So if the parent has $1 million of coverage, you can get the kid up to $500,000. So that's really important to understand. That's so you understand that, okay? Last one here. Let this thing go here. So someone said, how do we calculate if someone's asking for, let's say they want 20K a year from 65 to 85? You can just play with the numbers. I mean, realistically, you see, the number I had was about 18K, right? So it was close. I would just add a little bit more money in, and you'll get to that distribution number there. But the cool thing, Freddie, is you can do it right in front of your client. So when they ask questions, you don't have to say, hold on, or let me get back to you. You can do it all right there. This is a record for questions. So yeah, listen, I want to be respectful of everyone's time. Great questions. Dual contracting is a great thing. It means you can work with multiple carriers, multiple GAs, and not have to be pinned down to one. 50% of the agents we work with already have a relationship. We get that. We don't force you to do anything here. So I hope you all start writing more IUL cases. Reach out to your marketing manager, book a meeting on their calendar, and you can go ahead and get on the call with some of your top clients, because it's not easy to get clients, right? Well, we want to make sure we help you to cross-sell them and give them what they need here. What do they need? They need to have a bucket, a fourth bucket that's non-reportable and that's tax-free. Again, thank you so much, everybody. Really appreciate all your time. Let's see if we can write some more IUL cases for 2022, and have a blessed day.